Let me ask you something. What if you, as a teenager, could start building some serious wealth, like before you even get your high school diploma? Sounds kind of crazy, right? Well, it's not. And today, we're going to break down exactly how you can make your money start working for you.
Seriously, this isn't some fantasy. This is the whole point of investing. It's like unlocking a superpower that lets you turn the cash you have today into way, way more money down the road. And we're going to show you how to do it, step by step, starting right now. I mean, just look at that number for a second. Let it sink in. A single $100 bill, maybe from a few birthday cards, a part-time job, could become $1,500. And the best part? You don't have to lift another finger for that to happen. That is the magic we are tapping into today.
See, your biggest advantage as a young investor isn't having a boatload of cash. Nope. Your real advantage is time. And the one tool that turns all that time you have into actual wealth, well, that's what we're calling your investing superpower, the magic of compound interest.
Okay, but before we jump into all the cool strategies, we got to cover some of the basics. Think of this as like your quick money boot camp. We need to make sure you understand the game before you start playing.
Let's talk about a guy named Jake. He worked weekends and saved up $500, which is awesome, right? But then he spent it all on a new gaming console. Poof, gone. Now, what if he'd invested that money instead? Well, in less than 10 years, it could have nearly doubled to almost $1,000. Jake learned a tough lesson. Spending feels good now, but investing can feel a whole lot better later. And that brings us to a really important point. You need to know the difference between saving and investing. Saving is for your short-term goals. It's super safe, but your money's not really going to grow. Investing, that's the long game. Yeah, there's some risk involved, but that's the trade-off you make for the chance at much, much higher growth. So how does that growth actually happen? It's all about this concept right here, compound interest. It's the engine behind everything. You're not just earning interest on your first deposit, you're earning interest on your interest. That snowball analogy is perfect. The longer you let it roll, the more snow it picks up, and the faster and bigger it gets. Okay, so let's add two last things to your basic toolkit. First, risk and return go hand in hand. To get those bigger rewards, you got to be okay with a little bit of uncertainty. It's just how it works. And second, diversification. It's just a fancy word for that old saying, don't put all your eggs in one basket. You spread your money around, so if one investment has a bad day, it doesn't sink your whole ship.
All right, theory's over. You've got the basics down. Now for the fun stuff, the actual practical ways you can start putting your money to work. We're going to walk through 5 safe, super beginner-friendly ways to get started.
And here they are, your first 5 moves. You can think of these as a whole spectrum of options, from the absolute safest places to park your cash, all the way to dipping your toes into the stock market. We're going to break down each one.
Let's kick things off with move number 1. And wow, just look at the difference on this chart. A regular savings account at a big bank might give you, what, less than 0.5%? It's basically nothing. A high-yield savings account, on the other hand, can get you 4, 5, sometimes even more percent. It's probably the easiest first step you can take.
And this is exactly what Sarah did. She took $200 she made from babysitting, put it into one of these accounts, and a year later, she had an extra $10, just for doing nothing. Now, $10 might not sound like a life-changing amount, but for her, it was the first time she'd ever earned free money. And trust me, that feeling is pretty awesome.
Okay, on to paths 2 and 3. These are your ultra-safe options. If you're someone who really doesn't want to lose a single penny, these are for you. With a CD, you're basically locking in your money with a bank for a guaranteed return. And with Treasury securities, well, you're lending money to the U.S. government. It doesn't get much safer than that.
All right, feeling a little more adventurous? A custodial account is your ticket to the stock market. Because you're under 18, a parent or guardian has to help you open it and manage it. This is where you can start to buy things like index funds, which are basically these big baskets of hundreds of different stocks. It's a much safer way to get started than trying to pick individual winning companies. And just look at what's possible here. Mia took $300 she'd earned, and with her parents' help, she put it in a fund that tracks the 500 biggest companies in the U.S. In just 2 years, her money grew by 15%. This just goes to show you how powerful it can be to tap into the growth of the whole market. And finally, we've got path number 5, micro-investing apps. Honestly, these are a total game changer for beginners. Apps like Acorns will literally round up your purchases to the nearest dollar and invest that spare change for you.
You can start building a real investment portfolio with literally just a few bucks.
So, having the right accounts and apps is great, but they are only as good as the habits you build around them. Remember, this isn't about one big flashy move. It's a marathon, not a sprint. It's all about building a solid foundation that's going to last you a lifetime.
So here's your handbook for success. Number 1, track where your money comes from and where it goes. You can't manage what you don't measure. Number 2, spend only what you have. Debt is the enemy of building wealth. 3, look for ways to boost your income. A side hustle, asking for a raise. More income means more fuel for your investments. And 4, never ever stop learning. The smarter you get about money, the better your decisions will be.
Now, just as important as knowing all the right things to do is knowing what not to do. There are some really common traps out there that are super easy to fall into, and we want to make sure you can see them coming and steer clear. Here are 4 of the biggest ones. First, if something sounds too good to be true, like a promise to get rich overnight, it is. Run away. Real investing is steady and, kind of boring. Second, remember what we said about diversification. Don't go all in on one hot stock, it's just too risky. Third, watch out for fees. Even a tiny 1% fee can gobble up a huge chunk of your money over time. And last, and this is maybe the most important, don't freak out and sell when the market has a bad day. Panicking is the #1 mistake investors make. You have to be patient.
We have covered a ton of ground. We've talked about why, what, and how to invest. But I don't want you to leave thinking this is all just theory. So let's wrap this up with some inspiration from real teens who are actually doing this stuff and getting amazing results.
Check out Ashley. She started a small business online, invested the money she made, and turned $1,000 into $1,300. That's a 30% return. And now that money is going straight towards a massive goal, helping pay for college. She combined her hustle with smart investing. So cool. And then you've got Ethan. His story shows you don't need some big business to get started. He just uses his birthday money and spare change. He invests in super safe stuff and uses those micro-investing apps. And just by being consistent with small amounts, he's already built a nest egg of over $300. It all adds up.
So, there you have it. You've seen the power of starting early, you have the tools, you have the handbook, and you've seen that real teens are making this happen right now. The only question left is the one on your screen. What are you going to do? Are you going to open that high-yield savings account? Talk to your parents? Download an app? Your entire financial future starts with that one small step. So go take it. Your future self is going to be so glad you did.